Some people charge $5,000 or $10,000 for a trading course, some even $20,000. But in this video, I'm giving away everything for completely free. And I've been trading coming up to 6 years now, and I've made multiple 5 and 6 figures from these markets. And I've also helped hundreds, not thousands of students all over the world. And I promise by the end of this video, you're going to understand exactly everything that changed for me in my trading journey regarding psychology, the strategy I use, and managing risk the correct way. So without further ado, let's get into this video, and I'm going to introduce you to a new world in trading. We are going to get into the technical side of this video, teaching you exactly what to look for within the market. And also I'm going to be introducing you to one of my new time-based ranges. And yes, this is for the New York session. So keep on watching until the end of the video, getting into the point where we get onto the charts. However, at the beginning of this video, you do need to watch this, as I'm going to be going over trading psychology, breaking down exactly the mental barriers that I faced at the start of my trading journey, and how I overcame them to achieve consistent profits from these markets. So my trading journey is pretty boring but interesting at the same time. So I started trading when I was 17 years old, and I'm now 23 years old going into November. And all I wanted to do was understand these markets. So I had MetaTrader on my phone at the time, and I was looking at all these currencies going up and down. And I would take trades as I would go into university, and I was like, okay, so somehow I made $5,000, but the guy in front of me says to make $5,000 in a month, I have to work this amount of time, blah, 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 achieve this type of degree or whatever like that to achieve that kind of money. But I made it instantly. And from there, it really rewired the way I think about money and how money is actually perceived in real world. You know, a lot of people go through their whole life just after money as just the only source of income, but they don't realize they're ruining their whole life at the same time, because the amount of hours they're spending away from their family just focusing on work, although it's to provide for the family, it's just taking over everything that they're doing in their personal life. And that's exactly what I didn't want to do for the rest of my life. You know, I wanted something that could give me freedom of time. I didn't care about the money, and this was the only business that gave me money and freedom of time. So that's basically where trading started. And I would take losses on my trading account, and I'd be like, okay, why am I taking these losses? How did these losses even come about? You know, like, I was so confused because there's someone winning, you know, everyone was like 95% lose. Who's the 5%? 5% win. I want to be the 5%. And that's exactly all I looked for. For like a year straight, I looked for something that repeated within the market, and I found it. I found time-based systems, time-based logic, statistical data for day trading. And that was it for me. That was enough for me. For a year straight, I just straight looked at the charts. I'm sure you're aware of the MMXM trader. I'm sure you're aware of T-Trade. All of these guys, we all basically started trading together, starting ICT together, and we're all on a journey together. And it's amazing to see how far the space has actually grown and how many people we've actually helped all over the world. It's phenomenal. But that's basically where everything started. I started to focus on time, started to focus on statistics of how far the market's likely to expand from a mean average of the time-based range. And that's like basically in a nutshell how I started to trade. And that's really where I saw a lot of success, because I knew exactly what I was looking for. I knew exactly what was going to happen in the market, and I knew exactly how to execute on that system. And that's really where, if I faced any challenges or any doubts, that's basically, they all got eliminated, because I knew exactly what I wanted to do from these markets. And before I had that, I didn't have like any various challenges I faced. I would just crumble, because one thing for sure, trading brings out all your imperfections. So if trading brings out all your imperfections, you need to understand that no one is perfect in this game, even the people at the top level. Unless it's the high frequency algorithms, which have no emotions, but at a human level, everyone's going to have a way to deal with what's going on within the market. Some people deal with it the wrong way. Some people deal with it better than others. And you just need to realize how you can deal with yourself. You know, if you take a loss, how is this going to affect you? You need to be able to have something to rely on. And that's basically where I started to develop the repeatable strategy, focusing on time-based windows and everything like that. So I've introduced you to my London range. This is like 10% of my knowledge, even less than 10%, like 5%. And I'm going to introduce you to my New York range as we get into this video. But then you start to achieve consistent profits from these markets. And this consistent profit actually comes from understanding you don't need to make money straight away. You just need to learn how to day trade, because day trading is a lot different to investing. If you just want to see your money compound, just throw money into the S&P 500, throw money into the any index funds, and you'll see your money do well over a certain period of time. You don't need to look at the chart to do anything. But if you want to get into day trading, something is a bit wrong with you, something is a bit different. You wanted to achieve something that 99% of people never get to do, or even try, or even they just give up when they get to a point of realizing that it's pretty hard. So if you're getting into day trading, you need to understand it's one of the hardest businesses in the world. But when executed and done the right way, you can find the edge within it. And that's exactly where I started to pick up on. I understood that there's an edge to be made. There's money to be made. If I can develop and master myself, then I can start making those consistent money from these markets and understand what I'm doing. So I decided to make you guys a little flow chart as well with this psychological thing within the markets. There's main things that go into trading psychology. It's your mindset, it's your discipline, and it's removing your emotions and understanding how to manage your risk. This is mainly what goes into trading psychology. And if you wanted to print out this little flowchart that I made, you're more than welcome to do so. And this is basically a process that you can look to see how well you're progressing, So everything starts with you understanding your trading psychology, understanding something is not right? So something's holding you back from getting to the point you want it to be. And one of it is focusing on the right things, focusing on your mindset that is needed for you to get to becoming the trader you want to be. So mindset plays a key part, because if you have a positive attitude, thinking optimistically, right? You understand that the statistic is most traders lose, but you know that you can win because you've seen results from other people, but you've seen success in yourself. So the only thing holding you back is yourself, right? And you understand that the markets aren't a scam. The only person to blame, or the only external factors to blame, is yourself. Nothing else matters. So this is the attitude you start to develop. But if you don't develop this attitude, so you have no mindset, you need to focus on your discipline. This is where you need to focus on getting in the right frame of mind before you take a trade, understanding why you should be taking a trade, understanding why every trade should matter. There's going to be days. So you need to listen to this. There's going to be days where you spiral into losses. There's going to be days you tilt. There's going to be days where you have bad trading. And that's completely normal. Like none of you guys should be disheartened by that. And that's where discipline comes in. You need to be able to stop yourself. If you feel like that's what's going on or that's about to happen, that's where you step away and you understand this is what's going to happen. I need to stop doing this. And when you do that, that's exactly where you make progress in your trading mindset. And you no longer need to focus on your discipline because that's already built in. So your positive attitude develops into a growth mindset. And obviously, this is where everything just plays together. You have a growth mindset leads into your discipline. You have good discipline. This is where you have a consistent routine, sitting in front of the chart at an exact time. So everyone says build trading discipline. Let me tell you what trading discipline actually is. So you need to understand the strategy you're trading, how you should be trading it, how you should be executing it, when you should be executing on it. And if it all aligns up, you should be able to take that trade without hesitation. And that's exactly where discipline and a consistent routine plays a key part. And that's how you develop it. So don't go in front of the chart being like, okay, today I feel like trading the London session. Today I feel like trading New York. Today I feel like trading Asia. You need to know exactly the session you're about to trade, why you should be trading the session, and if your model forms, how you should be able to execute on it. And then that's basically where you maintain everything. You stick to your rules, and over time, this is where it's going to compound. And I decided to throw in removing your emotions. So you'll never really remove your emotions when it comes to trading. There will be points of where you're very emotional because you'll have a large winning day. After years of losing, one day everything is going to click and you have a winning streak or a winning month or whatever. And that's where emotions come in, because if you look back on your journey, you're like, wow, all this time I failed. And now look at me. I'm able to do this. I knew I would be able to do it, and I believed in myself. And that's where emotions are still going to play a key part. But what you can do is minimize your emotions. Everyone says trade like a robot. You're never going to be able to trade like a robot. I can 110% guarantee that, because we're all human. A robot's always going to have that edge over us anyway. But what you can do is minimize your emotions, like don't get overly happy on your wins and don't get overly sad on your losses. Understand that it's a cost of doing business if you take a loss, and understand if you take a win, it's just a P&L going up in your account. It doesn't mean anything short term. You always got to think long term, and you got to be emotionally aware when it comes to trading. Like you can't just be going through the markets blaming other things, blaming things that don't really matter, because the main person to blame if you take a loss is yourself. On the other side, the main person to blame if you take a win is yourself. It works both ways. So if you have an amazing winning trade, you can't just be the one that takes the crown for that. You need to take the crown for when you take a loss as well. And that's basically where you practice, and you have stress management, and then you have successful trading. So overall, this is where the main psychological issues come together, and they work together in a system. This system that I kind of made right here, understanding how your attitude and your mindset really changes the way you think about trading. Because every single day, if you go into the markets and you're like, okay, I think this might happen, I don't know if it will happen, my trading isn't that great, so you just second guess yourself. And that's where bad trading really just comes about, because you're already feeding yourself this information that you're not going to be able to do it. And you just looking at these markets, you're saying you're not good enough to look at these markets, where there's a lot of people a lot worse than you out there that don't even care to learn about this. Never mind watch this video, watch any videos on YouTube. All they care about is gambling in front of these charts. And you'd be surprised how many people around the world actually do this. So you watching this video, it's such a small percentage around the world. And it's crazy to think about, right? How many people actually care to learn, care to succeed within these markets. And this is exactly the approach I go for when it's looking at trading psychology, and if I had to break it down. And that's basically what I did for you guys. It's rewiring your brain into thinking you're already profitable, and knowing you need to be able to stick to these rules, stick to this mindset, and maintain this mindset to continue making the profits from these markets. As we went over the mental side of trading, understanding the mindset that's really required to see some sort of growth and money from these markets actually coming in, now we are going to go over the technical sides of understanding my time-based approach, understanding market structure, and understanding how I would approach the markets. And then we will get into risk management and move on to the charts. So building your edge within the market, the number one thing is understanding where price will go. This is the billion-dollar question. Where does price want to go? So 100% of the time, most retail traders are never going to know. But you can play the probabilities in your hands in knowing what price is most likely to do, how price is going to get there, and why price should get there. These three things, when answered the right way, this will give you the edge of knowing where price is going to go. So everything really is going to stem from the weekly time frame, right? So this weekly time frame, obviously there's one candle that goes into it, and that one candle builds up 5 daily candles. So your job as a day trader who wants to become profitable, you only need to capitalize on 2 or 3 of these days to be profitable. Unless you want to trade every single day of those 5 days of the week, which is completely fine, which you can do. You need to understand that you might be prone, or you will be prone to taking more losses. So your risk management, as we get into the next part of the video, has to be spot on. However, if you're selective with understanding your high probability trades, that's exactly where you are going to find more success. So how do you understand where this one weekly candle wants to go, and how do you go about understanding where the weekly time frame is basically headed? All this weekly candle can do is print a open low high close, or it could print a open high low close. And that's all you need to understand. Now, by understanding this, all you are going to do is profile your week. So in a bullish market, this is all you're looking for. Down close candles to support the market to the upside. So every time the market trades lower, it trades into a down close candle. This supports the market to the upside. So now we understand this is a bullish market. What is this also? This is a bullish trend. This is actually identifying a trending market. You know, a lot of people talk about this is the market going higher. Well, of course, that's the market going higher, but how is it going higher? What's supporting it going higher? It's not random support and resistance levels. In a bullish market, that's how it's going to look like. In a bearish market, this is exactly how it's going to look like. Up close candles are going to support the market to the downside. So why am I even talking about this? Well, very simple. This is where we are going to have a understanding of where the market wants to go. So this is where we built up a bias from a weekly time frame. Now, this is what we do and what we look for. We are looking for high of the week, either on a Tuesday or a Wednesday, if we are bearish. So if the market opens up, pushes higher, what are we understanding? As the market's opened and pushed to the upside, this is where we are going to have the high of the week most likely created. This is where the ideal selling setups are going to form until the market sells off into the objective it wants to reach. And normally the low of the week is going to form on a Friday and the market's going to push back into the range. And we just identified where the weekly candle wanted to go, or how the weekly candle was going to form, basically just by looking at this right here, the market structure of this market and how up and down close candles are supporting it. Obviously, when we are bullish, the market's going to open up. We are anticipating the low of the week. So as the indices have been bullish, I've been looking for the upside a lot more. And this is where we make the low and then we push to the upside. Monday usually makes the low of the week, and then we have the expansion to the upside in the index futures markets. And you can see this is where we will have a run higher. So wonderful. We've understood what the weekly candle wants to do. We've got a bias in the back of our mind, right? Every single day we have to go into the markets knowing where the higher time frame wants to go. So if we know that the higher time frame is bearish or bullish, this is where things get interesting, and this is where my time-based ranges come into play. So stay awake, because we are about to dive into a lot more source regarding these markets. And if you did want to learn more about these markets in detail, understanding why time-based ranges work, why the market's working in time-based cycles, and what is the time-based cycle that the market's working within, that's exactly where you can look to join or apply for my Blueprint Academy. The link to that will be in the description down below. So number one thing we spoke about was understanding if the market's bullish or bearish. So for example, we are going to say this market's bullish on a high time frame basis. So the weekly candle wants to go higher. This is where we are going to start to look at time-based ranges and look at ranges within the market and how to identify them. So this is a market pushing higher. This is Monday. So within this range that's made, ranges are so important because as well, we have liquidity areas that we can easily identify. So above this high, we have buy side. Below this low, we have sell side. However, within this range, there's going to be a time-based range, and this time-based range has liquidity already above the marketplace and liquidity already below the marketplace. And this range right here is my London range, and this starts at 112 and it finishes at 212. And the framework to this range is you're looking for the market to take out one side of the range right here, and then you can target the opposing end, which is the low. And this also pairs up with our overall range that we've identified. However, keep this in mind. We've identified the higher time frame is bullish. If the higher time frame is bullish and we want to see the market create a low of the week, and today's Monday, what does this mean? This means this run higher at 3 a.m. So everything is on New York time. And you can see at 3 a.m. we take out the buy side liquidity, and then we can trust the selling setups to this low. Why is that? Because this also aligns with a higher time frame narrative, because if the market's going to go higher, it's going to go lower first to make the low of the week. And this is where we can pair up the other logic within the market. We have 3 a.m. buy side liquidity above here, time-based range right here, and then we have sell side liquidity below this low. So all of that paired together, you have a very high probability trading setup. And then this is where you look for a change in delivery. So here, I'm going to introduce you to this type of delivery that's changing. So this is where candles pushing to the upside. So imagine this is 3 candles right here. So this one trades into liquidity. So this area right here, this trades into, and this is how it's going to look on a candlestick level. Then this candle pushes lower and closes below both of them. This is where we make a swing low, right? This candle, well, these two candles, they get paired up as one because they're bullish candles, As the market retraces higher, we should hold 50%, so 50% of these two candles together, and that's a selling opportunity for us. This is a delivery that's changed. So by definition, what is an order block? A order block by definition is a change in delivery. So this is where we change delivery, order block retraces black. This is where we can look for downside, and that's where we trade into the sell side liquidity and looking at the markets from a logical level by having a profile from the week. You know, if we're bullish, higher time frame, we're looking at Monday low of the week. If a selling setup occurs because we traded above the range high, traded above this overall dealing range, this is where we can look for the market to trade lower. So everything always stems from a time-based approach. And next time window that I am introducing you to, and I promised I never would have taught this on YouTube, but I guess it's time. Some of you guys are finding a lot of success with my London range, so I thought I'd teach you this one for New York. And this range is another one of my blueprint ranges. It starts at 812. I want you to backtest this, not just take my word for it, but 812 finishes at 912. So this is called my blueprint range for New York. And this range has a very high win rate because you know exactly what to look for, how the market should form, and how you can trade it. So this range starts like this. We have liquidity being built up within the market, and then we have an overall range of the market, right? So we have our time-based range and then the overall range. Liquidity is above this high that we've taken, liquidity is below this low that we've not taken yet, and we have liquidity resting below here, liquidity resting above this high. And what did we speak about from the weekly time frame? It's understanding where the weekly candle wants to go. So for example, imagine this is a bear market. So the weekly candle is bearish. We're looking for the downside. This is where we have our time-based range. So we've created the high of the week on Tuesday. This is Wednesday. And this is how the price action is looking on Wednesday. We have a time-based range right here, and we have an overall range of the market. So let me just color this in so you guys can see. So this is Wednesday. Tuesday's created the high of the week already. So logically, from a higher time frame, you know that you're already bearish. Now, this is where the market will trade higher, take out the buy side liquidity. Once we take out the buy side liquidity, where is the actual liquidity targets? The actual liquidity targets are below the blueprint range in the New York session, which is this one. And you can see this is where price will do the exact same thing that we spoke about before. And then we take out the sell side liquidity. And this range is super powerful because it repeats near enough every single day. As I said, you can trade every single day. You can trade every single day with logic within the market because this is where we have our time-based cycle that repeats every single day. So you can just plot it onto the chart. You don't need to worry about your dealing range or anything like that. This range is going to be automatically applied every single day, and you can trade it very mechanically. And don't worry, we are going to get into the chart and go over this range as well as we develop more into the video. But as I said, this is just the tip of the iceberg. Most of the teachings and most of the advanced teachings are all done inside of my Blueprint Academy. So if you're someone that does want to learn more about these markets, learn about the why, that's exactly where everything just comes about. But you can see this is a logic every single day I'm using within the markets. I have a range. I'm always looking for liquidity to be taken within the range. And then I'm having a time-based range, which is telling me where the market's likely to retrace or trade into. I'm a retracement and a reversal trader, so this is exactly how I like to trade them. Every trader is going to be different, and that's one thing that I wanted to speak about as well. Like every single one of you watching this video, you're going to have a different personality to me, but everything that I do go over, you can apply it to a higher time frame basis, lower time frame basis. So this is all done on the 5-minute chart or anything lower than the 5-minute. All of this trading that I'm going over. Moving on to the charts and breaking down what we were speaking about before, you can see we have 1, 2, and then this candle closes above. So we have a down close candle right here. This is where we change delivery. This is the weekly time frame, and this is where we change delivery. And now we have a down close candle that's supporting the market to the upside. And you see this where these candles are making the wicks. That's exactly where you want to position in for the longs or the buying setups. And obviously you're going to get weeks like this where the market just pushes to the upside without anything. But again, every time we make the wick, this is exactly where we're making the low of the week, and that's where you want to capitalize on it. And that's where the logic of down close candles supporting the market to the upside comes into play. You can see this is the market still trading at this down close candle. I do expect us to take out this high eventually, but this down close candle is still holding up the market. Until this down close candle stops holding up the market, we make a swing high, close below this up close candle, then we can look for a retracement in this market. You know, the market can trade into this fair value gap right here. But for now, I would rather play the buying setup. And how does this look on the lower time frame, and how can you blend my blueprint ranges? So here I have an example from Friday, the 22nd of August. You can see we have a low that was made within the market. Then we have the second candle, then the third. This closes above this down close candle. Once we close above this down close candle, we have a fair value gap. Market closes above this gap as well. So this is your first initial buy once we change delivery. And why are you looking to buy this market from this point? This is because we have our time-based range. So that time-based range is holding liquidity. So this is an area that we want the market to trade into. So you can actually refine your stop a bit more. If you didn't want it below this low, you can take it a lot higher and put it below this fair value gaps low as well, looking for the target of the time-based range. And as we spoke about, this is how you're trading it mechanically. We have the range, and then we have an overall range of the market. So where is the overall range of this market? You can see we have, if we zoom out, we have a low right here, and then we have a high above this right here. So what has just happened? This is my London range, 112, finishes at 212. This is the range that has liquidity. This is the overall range of the market. We have a low and we have a high. We take out the low of that range, change delivery. This is a good buying setup. Why? Because we've taken out the liquidity. We have liquidity resting above this high and liquidity resting above that high. Now we can look for the market to continue trading in that direction. But it doesn't stop right there. Let me go one to the right. Same day, we have my New York range. We have liquidity which is resting below this low, and we have liquidity which is resting above this high. So all I'm doing is looking for one side of the range to be taken to target the opposing end, and you can see this happens in nearly seconds. This range is pretty much every single day, but you need to be on your toes and understanding where the market's likely to move. So let's look at another day, for example. So we have this day right here, Monday the 25th of August. What does the market need to do? If we're bullish, as we are on the higher time frame, we are looking for the market to trade lower. So if we zoom out a bit, you can see we have a dealing range. We have a low, and then we have a high above this right here. And where do we have liquidity? We have liquidity resting above our time-based range. So as we have liquidity resting there, what are we waiting for? Well, we're waiting for a buying setup. We take out the liquidity right here. Once we take out the liquidity, 1, 2, 3, fails to change delivery. As we fail to change delivery, this gets into 5 a.m., 6 a.m. No trading setup. So there's no buying setup for us in London session. A lot of people are like, okay, so what happens if there's no setup, or how do I identify there's no setup, or what if I take a loss? Number one, if you take a loss, then that's fine. If you followed everything that the model offers, then it's completely fine. You know, it's just a cost of doing business. But here, once you trade lower, you are looking for the market to change delivery, show us that it wants to go to the upside. If it fails to do so, then all you are doing is waiting for the New York session. Although this was a very choppy day, and this is on the 5-minute time frame. This range in the New York session, I want you to backtest this. It's only a 1-minute range. So the London one you can trade on the M5, but this one is the only range that you trade on the M1. So we take out we take out the high, target the low, and that's exactly what happens. Price just plays around with this range. You know why? Because this range is actually working within the market. These ranges actually hold value to the market. And what did we speak about before? As we took out the low of this range, the market trades into that. Very sensitive at these levels because these are real levels getting used within the market. And now one more example before we move back on to understanding the risk management side of trading. But you can see we have a dealing range, we have a low, and then this is the high of the range. So we've taken out the overall dealing range low, And then we have the time-based range is high, and then we've taken out the sell side liquidity. So here, once we take out liquidity, this is where we change delivery above these three down close candles. This is where you can look for your buying setup on this market. If you're using 50% of the gap, stop below these bodies, looking for a run higher to target the liquidity pool above our time-based range in the London session. And now, exact same thing is done for New York. So this is 2 trades in a day. You know, like, I want you guys to backtest what I've just given you. 99% of the information on YouTube, nothing even comes close to this. And it just brings a smile to my face. You know, I'm able to share it with you guys all over the world, but it's a small fraction that'll even make it this far into even understanding what I'm trying to say. But you can see we've taken out the buy side. Only logical area to target is the sell side liquidity. So I want you to do your own due diligence. I want you to study on your own. And I want you to look at this range, how it's forming within the market and how you can apply it on the 1 minute time frame. Exactly everything I've taught here, but you apply it to the 1 minute. Offers 2 trades in a single day, knowing exactly what's going to happen, how it should happen, how you should be trading it. And now let's go over a risk management approach, but I've given you guys information that's worth more than all of these paid courses combined just for free on YouTube so far. Okay, so understanding risk management. So let me get this trusty marker right here. So obviously you guys, I'm not going to give you guys the exact risk management to take per trade, you know, because that's all subjective to you, how much you like to risk, what you want to risk. And one thing I would obviously recommend is don't risk your whole trading balance in one trade. But you can always assess the market environment, how you can basically just justify where the market wants to go and how you would approach it with the right risk. So first thing for this risk management thing is understanding what is the market conditions like. Is the market chopping? If the market's chopping around, then no matter the risk that you're putting in, you're most likely to lose it because the market doesn't want to move. So no matter how much money you throw at the market, no matter how much lots you throw at the market or contracts you throw at the market's not going to move if it doesn't want to move. So that's something that you need to accept. If you can't accept that, then that's obviously where your risk management gets thrown out the window and you take lots and lots of losing trades because of that. But first thing is assessing the market conditions. If the conditions are favorable, then this is where you set a plan of risk. So before you take a trade, you need to understand how much you're going to risk for that trade. So if you're risking $400 on this trade, this is where it's already predetermined for you. You need to know exactly where your stop loss is going to go. So you have a predetermined risk to reward. So if you're aiming for a 1 to 3, 1 to 4, 1 to 5, whatever, you need to know where the market's going to get to, how the market's going to get there, and how you can utilize it. So we have a determined risk to reward ratio, and you need to set your stop loss. So you need to know where the stop loss is going to go. I like to use old swing lows and swing highs depending on the bias of the market, but I also like to put my stop losses below order blocks which change the state of delivery. So this is where the side of trading which is subjective comes into play, because I can give you all the source regarding these markets like I am, but you need to understand that most of it's also done on your own, you know, and that's where a mentor or something does actually come into play, because if you are struggling with a certain thing, you can ask them or how they can help you get to the point you want to be at. And then once all of this just comes together, you execute on the trade, you monitor the trade, and that's where you will have your any adjustments that you need to make. And if you don't need to make any adjustments, then that's where you will leave your stop loss where it is, and you can close the trade or review the outcome of the trade. However, if you modify your stop loss, you're monitoring the trade. If the trade doesn't close, then you basically just learn from your experience. So this is where journaling, as we're going to get into the importance of journaling, but I'm not going to talk about journaling your emotions or anything like that, but just journaling the things that actually matter when it comes to trading. So this is where you'll have a risk management plan. All of this needs to flow together. You know, once you're in the flow of things in a trade, this is where you will have something pretty good. So you don't want to be a machine gun approaching these markets. You know, you want to have 2 or 3 or 4 good bullets that you can throw at the market, know exactly what you want to do. So you assess the market if the conditions are favorable or not. If the conditions are, you have a set risk management plan. You've determined your risk to reward ratio. You've set your stop loss, execute on the plan. You didn't hesitate at all. You monitored the trade. how it's doing, what it's doing. Do you need to adjust it? You don't need to adjust it. So you're all good. You continue monitoring the trade closes, and then you review the trade. And that's where you will learn from your experience. So learning from all of this, actively taking trades is really good. I know a lot of people say, don't trade, don't do this, don't do that. You actually need to trade. You need to take these losses. You need to learn from experience, because that's going to be the best teacher. Because if you get into the market and you see a certain condition, you're like, okay, I've seen this before. Should I really be executing on it? Should I really be testing my edge? You can 9 times out of 10 tell that you really shouldn't be within this market, and how you should be approaching it going forward. And this is where risk management plan, knowing what the market wants to do and having the right mindset all comes together in giving you something beautiful, a beautiful approach to these markets. And that's what I like about trading, understanding exactly what's going on in the markets, having risk that I know that I'm putting in the markets, and nothing is really guesswork. Because if you can minimize all the factors in day trading that is quote unquote guesswork, that's where things become a lot easier for you in executing a trade and understanding what the market wants to do and trading it live. And that's where this is what I'm showing you with the risk management. And now the final thing I'm going to go over is having a journal, understanding how to journal the correct way and why this will help you in your trading. So looking at building a journal, this is exactly the approach I take. I don't care about writing down my emotions or how I felt when I was in the trade or anything like that. All I care about is the asset I'm trading. So I only trade NQ, but this is a few other examples that I put for you guys. So this is how your journal or your journal setup should really look. You have a table of everything. You have your trade setup, reason for trade, setup formation time. So obviously this is just the 26th of August, 27th of August, but you need to write down the exact time this formed, the exact time for the exit on your trade, and then what type of exit did you take on that trade? Because did you take a full take profit? Did you take a stop loss, or did you manually execute, or did you have a break even? This all also plays a key factor in your trading, because when you look back at the exit times, the time of execution, and the setup formation with enough data, this is going to tell you a lot about your trading. And then you have your risk management. So how much did you risk per trade? You know, this is how much you risked. How much profit did you make per trade? And this is where your risk to reward will even out. And the only thing you need to write down is your note. So like this is the trade you took on Euro USD, for example, strong follow through, blah, blah, blah. You don't need to read about this breakout and all of this stuff, but that's exactly what you should be writing down regarding your trades. It should be just a few lines, even for the reasoning for the trade. Just if it took the high of the range, low of the range, why you execute and change delivery. And then for the notes, I did execute a bit early, I did execute a bit late. And this is where all of this data within your journal is going to play a key factor, because if you've been losing for weeks or months or even a few months on end, you can look at your data, and this takes a lot. So this takes a lot from a trader and a lot of effort. They look at their journal and they're like, okay, so this exact time, this exact day, I always lose. This is counted for numerous losing trades. That's why I've had all of this losing streak. And that's where you can minimize that day. You can basically just refine your edge even more from a journal. And that's why I like to just note down all of this stuff in a table format. And I don't really, it takes me like 5 minutes. It doesn't take me any longer than that. And that's all I do. I don't need to write down how I felt for the day. I don't need to write down how my emotions were when I was within a trade, because none of that really matters when it comes to a journal. Because obviously if you take a huge loss, so if you see a pattern in your trading where you're risking a good amount of the balance, but then randomly you risk 10% of the balance out of nowhere, of course that's going to hinder your growth. But of course you're going to know why you did that. It was, of course, you were trading emotionally, and you don't need to tell yourself that you were trading emotionally, you did all of this wrong. You should already know, because the only way to progress in trading as well is taking self-accountability, taking accountability for yourself. And you need to be able to take accountability for everything in life too, because if you take a loss, if you take a win, all of that is on you. It's on no one else. That's one thing a lot of traders fail to realize. They fail to take accountability. And that's what holds most of these people back, because they don't have a journal and they don't know what to look for within the markets, and they don't have a strategy. So when they look at the markets, they're trading off how they feel. And you should never trade off how you feel. You should know exactly the risk you're about to put in So the risk amount, you should know where you're going to take your profit, if it's going to be a hard TP or whatever. You should know exactly the timing and the day you're going to execute on your setup. So what setup's going to form. You should know the reasoning for your trade, and you should be able to note down what happened if it went wrong, what happened if it went well. And that's exactly where good trading comes about. And it sounds very boring, it sounds very tedious, but these are the things a lot of you guys need to do to get to the point you want to be at. And I hope this video did clear up a lot of things. I went into a lot of detail regarding things that can help you change your perspective to the markets, because trading is all about perspective, right? If you don't have a perspective of the real world or a perspective of money, these markets can destroy you, because you don't really know what's going on regarding the money that's coming in. You know, you see numbers moving on a screen, but you don't know the value of it. And you should always put that money that you see on a screen in perspective of real life. And that's exactly what I like to do. But with that being said, if you made it this far into the video, you are a part of a very few fraction of people that watch this video all the way until the end. And I hope you did find it useful regarding my new time-based range. Don't worry, we are going to be developing on this understanding in future upcoming videos. But I thought I'd give you a whole full video going over everything, giving you an amazing approach to the markets, breaking down multiple things that you need to consider in your trading and other things that you don't need to consider in your trading. You know, a lot of people think journaling is boring, but when you do it the right way like this, it takes a few minutes and it gives you data that can be applied long term. So with all that being said, I am going to conclude this video. If you do want to learn more from me personally one-on-one, then you can go into the description down below. The first link, you can apply for my Blueprint Academy. However, I wish you all a good rest of your day wherever you are watching this video from in the world. And remember, I'm rooting for you, and I hope you do find success in this business.